When accountants use the phrase pro forma, they are using a Latin term that translates to according to form, or more practically, as if. These statements step away from historical reality to map out projected results. The entire purpose of building these financial projections is to look into the future and ask a crucial question. Will our planned business activities actually generate an acceptable level of income, and will they keep the company solvent? To answer that, financial professionals rely on the principle of articulation. You cannot draft one projection in a vacuum. Every schedule, budget, and assumption is mathematically linked. Ultimately, a complete set of pro forma statements serves as the terminal output of the master budget, an interdependent system where every operational unit provides the data for the next. This flowchart represents that comprehensive master budget framework. The top half maps the operating budget, starting with short-term goals and cascading down through sales, production, and cost schedules. Those operational inputs eventually filter down to the bottom of the structure, generating three terminal documents: the pro forma income statement, the pro forma balance sheet, and the pro forma cash flow statement. Every assumption made by management flows downward. A change in the direct materials budget up top mathematically alters the final predictive documents at the base. Mapping this structural flow is the prerequisite for using these statements effectively. Once the architecture is in place, management can use the model to run strategic ratio analysis and stress test the company's future. Looking closely at the center of the diagram, notice the horizontal line separating the operating from the financial budget. Crossing that line requires specific inputs. For example, the cost of goods sold budget bridges the gap directly, feeding into the pro forma income statement. In corporate finance, the pro forma income statement is forecasted first by necessity. Its terminal figure, net income, is a required input to calculate retained earnings on the subsequent pro forma balance sheet. To accurately build that first projection, analysts need a mechanism to separate the costs that fluctuate with production volume from the static obligations that remain fixed regardless of how many units are sold. Analysts achieve this bifurcation by applying the percentage of sales method. This table shows an implementation of the percentage of sales method. We have historical data for year 5 on the left and projected year 6 forecast on the right. Examining the middle forecast basis column reveals which line items scale proportionately. Sales and administrative expenses are projected to grow by 11%, represented by the 1.11 multiplier. Cost of goods sold is locked in to scale exactly at 80% of net sales. But down below operating income, the scaling rules change. Other revenue and interest are explicitly marked as remaining the same as last year. Interest expense does not increase just because you sell more products. It is anchored to pre-existing fixed contractual debt obligations. By anchoring fixed costs while scaling variable costs, the model creates an accurate representation of operating leverage. The final projected net income reflects the reality that as a business scales, its profit margins typically do not move in a perfectly straight line. Once this baseline projection is built, management uses the model proactively to manipulate strategic targets and stress test their assumptions. Consider a scenario where we test a 6-point increase in pricing efficiency. On the left, a baseline model projects a 69% gross margin. On the right, we test a target of 75%. Because the spreadsheet is linked, that margin improvement cascades down. The operating income line automatically surges from roughly $797,000 to $891,000. Pushing further down past taxes, the impact hits the ultimate metric for external investors: basic earnings per share. The single margin tweak pushes the final EPS projection from 9.6 cents up to 10.7 cents. This demonstrates the sensitivity of the model. A 6% margin adjustment results in an 11% increase in projected earnings per share. This precision allows executives to map exactly how an operational change scales through to the stock's valuation. This same articulation applies to capital structure decisions. This prompt describes a company acquiring new equipment by trading in old machinery and financing the remaining balance with a 3-year loan. That singular decision immediately ripples through the financial models. First, the pro forma balance sheet logs an increase in debt to reflect the principal of the new loan. Because the statements are linked, that new debt balance automatically triggers a calculation on the pro forma income statement, populating a brand new line item for interest expense. Finally, the transaction hits the pro forma statement of cash flows in two distinct places. The influx of borrowed cash appears under financing activities, while the subsequent cash payments for interest reduce cash flow from operating activities. A master budget is a fully articulated system. A single operational adjustment or new financing agreement will inherently mutate the entire financial picture simultaneously. While internal management uses these models to plan, external stakeholders like banks and stock analysts use them to judge. Creditors demand to see a company's finalized pro forma balance sheet and cash flow statements to evaluate future liquidity and financial flexibility. They are looking to test compliance with debt covenants. Commercial loans require strict financial ratios, like a maximum debt ratio, total liabilities divided by total assets, and a minimum times interest earned ratio, earnings before interest and taxes divided by interest expense. By demonstrating that the forecasted financials clear these ratio thresholds, the company provides the bank with mathematical assurance that it will remain solvent over the lifespan of the loan. Pro forma models act as the translation layer between corporate ambition and capital markets, providing banks with a mathematically consistent framework to evaluate whether a company's proposed strategy is actually viable. But this process inevitably raises a critical question. What happens if the final pro forma calculations reveal a projected loss or a covenant violation? If the numbers indicate an unacceptable outcome or a covenant breach, the entire financial forecast is rejected. That rejection forces a hard reset. The failure at the bottom of the flowchart traces all the way back up to the operational planning phase at the top. Management must physically go back into the blueprints. They have to adjust their base assumptions, perhaps by aggressive cost-cutting, finding alternative financing, or revising their sales targets, and run the entire master budget sequence again. Financial forecasting is a continuous diagnostic loop. It acts as an organizational governor, forcing a company's operational ambitions to fully reconcile with strict mathematical reality long before a single dollar is actually spent.